Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Hi, everyone, and welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs. I want to start today's episode off with a very exciting announcement. In case you're not a subscriber to our newsletter, you may have missed it. But last week, we reduced the fees on our flagship asset allocation ETFs. So I'm really excited about this and the fact that we're now providing really even more value to investors. So we've reduced the cost of an already very cost-effective ETF to 15 basis points. That's the management fee. And this makes BMO's asset allocation ETFs amongst the lowest cost in the market. So another good reason to, as we like to say, consider Z instead. Today, we are going to talk all about active and passive investing, the age-old debate, and we'll be diving into the popular research by S&P, which they've been conducting for over 20 years now, the SPIVA reports. So I'm sure you've heard of them. We like to have Joe on every year to take us through the latest results. A quick Google will allow you to find the reports in full, or you can go to the S&P Dow Jones Indices website. I'll also pop it in the description below so that you can find the full report. But today we're going to take you through the highlights on the latest findings. Before we do get started, a quick reminder that we're not providing investment advice or recommendations. As always, today is about information and education. Joining me today is Joe Nelesen. He's the head of specialists for index investment strategy at S&P Dow Jones Indices. His group is really responsible for providing the research and commentary on their entire product set. So that includes U.S. and global equities, commodities, fixed income, and different economic indices. So Joe, welcome back to the channel.
Thanks, Erin. It's great to be here.
We had you on, I think it was in the winter, January, to talk about the sector-specific research. So any of our listeners who missed that, make sure you go check that one out after today's episode. But today we're here to talk about SPIVA. So Joe, let's kick it off just with a brief intro in terms of what is SPIVA, what is it aiming to measure?
Yeah, sure. Thanks, Erin. I'm going to spell it out in a little detail. You mentioned we've been doing this for 20 years now. And so SPIVA, it's an acronym. It's SPIVA, and it stands for S&P Indices versus Active. And as you said, Erin, you can Google that. You can ask your favorite AI, whatever you want to go find it. It'd be very easy because we have been doing it a very long time. And it's really become probably the most cited, active versus passive piece of research. Even among people who don't know the name of it, I've heard people on airplanes talking about this some of the data, right? And just anecdotally. And we've actually been doing it for 23 years. We started in 2002. We're at a point now where we're doing mid-year reports as well. So kind of every 6 months across multiple regions. We actually cover 9 regions around the world, multiple countries within those. And Canada is a very important one. Collectively, globally, it's about 20,000 funds we analyze in every cycle across equity and fixed income, and close to 40 different categories in some of our reports. And really, as you noted, the crux of it all is measuring the relative challenges of picking stocks and bonds in an active way around the world. And we expand that into other areas as well, institutional, without fees or after taxes, et cetera. So it continues to evolve.
It's all about that time in the market, not trying to time the market, as we always like to say. Can you walk us through the actual calculations? Like how are you actually building this research behind the scenes?
Sure, that's important. I think we also really value the transparency of it all. We do write a fairly lengthy methodology section in each of these, which are mostly the same, but they do vary a little bit by region. And right, so in the case of Canada, we use a third-party data set from Fund Data. It'll be different providers around the world depending on who has the best kind of resource for active funds. And in those data, we do a lot of what we call data cleaning, right? So we'll go in and look at if there's multiple share classes. Our methodology is to choose the share class with the largest amount of assets, right? We exclude things like leverage and inverse and leveraged funds, right? Because they're kind of really different than this comparison. That leads me to this apples to apples comparison we talk about as well, where we'll really try to match the fund with the most appropriate benchmark that is really, adjacent to its style and its holdings. And so that takes a little bit of, sometimes adjustment because different providers have different names for things, but we'll compare to a benchmark within the S&P family, which is pretty easy because we run almost 1 million of them in different indices. And then we're measuring a lot of different ways of cutting the data, right? When we compare manager performance as an aggregate, we do it on an equal weighted or an asset weighted basis that takes into account how people are really, dedicating their dollars as investors, and ultimately try to put it as close as we can to what the investor experience actually is.
One of the questions that always seems to come up when I'm listening to you speaking on these reports is survivorship bias and fund closures and how that's factored into the analysis. Can you touch on that?
Yeah, that is a fourth feature of the methodology, and probably, in my mind, one of the most important ones, and I'll share why. And survivorship bias, just so everybody's on the same page, is where if you look at a universe of funds today and say how many of them outperformed, what you're neglecting to look at is how many disappeared during whatever backwards period you're observing because they failed to outperform, right? Funds that close typically are not doing well, and that's why it happens. And so what we do is we use data that starts at the beginning of a period, right? So if we're talking about a 20-year, 10-year period that ends in 2024, we're looking as the initial universe, all of the funds that existed at the beginning of that period, and looking at when certain ones closed, or merged, or liquidated, or in addition, changed styles, which is actually quite a common occurrence as well, right? Managers change their style and investment objective. And so when you factor those numbers in, and just to give you a sense of the magnitude, in Canada, over 10 years ago, we had about 730 or so funds in the starting universe, right? The number of those that disappeared over that 10 years was 39%. That's significant, right? And so those were underperformers. And in some categories like Canadian equity, it's close to 50 at 47%. So it really matters tremendously to look at survivorship.
I'm curious as to how big your team is that's actually conducting this research. It seems like such a huge undertaking.
We're not a very huge team, but we're a very ambitious team, and we have a lot of computing resources that we heavily lean on. Yeah.
All right. We're going to focus on the Canadian report today because we're talking to Canadian DIY investors. What were some of the most notable takeaways from the latest report?
Well, Canada's always an interesting market. I love to write about it, right? Because there's so much going on, but at the same time, there you can have some really interesting dynamics moving things. In 2024 was definitely among the more difficult years, mathematically speaking, for active managers. And I'll give you a few examples. Well, part of that, by the way, one side note, one trend that we kind of see across markets in time is that when markets are very strong, when a market is up a lot, like we've seen kind of globally in 2024, active managers tend to do slightly, less well, right? It's always a struggle to outperform, but those proportions are even higher, that underperformance number, because the benchmark is higher, right? And so that hurdle is more difficult. Last year, across categories, you had an average in Canada of about 80% of active funds underperformed their benchmarks, right? So that's kind of a cross-category average. In the Canadian equity category, you're up around 89%. I think one of the best categories on the other end was international, which again, best is relative, right? It's about 72% of those funds failed to beat the benchmark. And so again, that's just the 1 year period, which can be interesting, but I think people invest longer than that. And so when you look out, 5 years or longer, you're seeing underperformance rates converge to around 80 or 90% or more. And that's something that we see not only in Canada, but in all types of markets.
Yeah, I was going to ask, how do Canadian equity managers compare to US or global counterparts in terms of that outperformance?
Well, that is a great question. And I think there's a few ways we can look at that. One is in sort of the flagship domestic equity category, right? In virtually every SPIVA, it's kind of, Japan equity or Canada equity or US equity. What are those managers doing in their home country? And it varies year to year. And so in Canada, we saw that in the Canadian equity category, 89% underperformed. And if you compare that to U.S. equity managers of U.S. equities, they were at 65% last year, which was kind of around the long-term 1-year average for US. So it was a tougher year in Canada. And I think we did see this across other categories as well. But another point of comparison, I think, is if we look at the managers of the same asset class across domiciles. And there's two different ways that we look at that much more now, which is US equities and global equities, because those are two fund categories that we see, virtually everywhere in major markets, right? And so we adjust the currencies, we put the benchmark in the same currency as the funds, et cetera, apples to apples, right? And in Canada, we saw Canadian managers of US equity have an 85% underperformance rate last year. So as I mentioned, that was higher than the 65 in the US. In global equity, so managing against world, it was 90% underperformance in Canada and 84% in the US. Those were quite a bit closer, but still quite challenging. And so I think we do see this as something not unique to Canada. It's those low rates elsewhere as well. No one has a really strong advantage in managing U.S. equities around the world, including U.S. managers.
Now, this SPIVA report goes a little bit deeper into different styles or sectors. Are there areas that saw the biggest divergence between active and passive over the past year?
I think one of the biggest divergences I saw, actually one way I think of looking at this is through maybe the interquartile range, right? And that's where you're looking at, what is the percentage of performance that gets you to that top quartile or the bottom quartile, and median is in between. And the categories where we see the biggest spread were, as I mentioned, U.S. equity and global equity. That's where we saw, for example, in U.S. equity, the bottom quartile manager in Canada was trailing the S&P 500 by about 15%, right? And over the top quartile, interestingly, they're still trailing by about 2.5%. So pretty big spread there, right, of more than 10% between top and bottom quartile. But notably, even if you pick a top quartile manager, you were still in underperformance territory for a lot of them. So that was one of the big spreads. And I think from a just general style perspective too, last year was a year that we saw small caps do slightly better than larger cap stocks in Canada. Often when that happens, that tends to be slightly more favorable for active managers. It wasn't the case necessarily last year, but that moving away from concentration of performance can sometimes be helpful, but it didn't make that big of a difference when, especially in these global categories where the dominance of frankly the U.S. on a global stage in 2024 was quite hard to overcome.
Interesting. Yeah, it's interesting how trends, sometimes there's surprises, right? And it's not always going to pan out that way. One of the reports that I like that is included within SPIVA is the performance or the persistence scorecard. So can you highlight this for us and what this attempts to measure?
Sure. I love the persistence scorecard. I mean, obviously I'm a nerd, right? So we like these data, but I like the story that it tells because it fits naturally into the SPIVA conversation. And it really was an evolution of how we had this discussion globally. What I mean by that is when you present someone with SPIVA data, whether they're a fund selector or manager, et cetera, let's say fund selectors really, a common response would be, well, I get that most funds underperform. This was proven out by academics quite a long time ago, but I don't pick underperforming funds. I pick good managers, right? The ones who stay on the top. And so we asked ourselves, well, that's a great question. Number one, how many of them do stay on the top? Those that outperform that less than 50%, and for how long? And that sort of informs how hard it is for any of us as fund selectors to pick them. So persistence looks at that, right? We look at the top quartile, the top half, the outperformers, and see how long do they stay there over subsequent years. In Canada, one of the pieces of data in the Canada persistence scorecard, it was this, that if you go back just 3 years, right? So December of 2020, you're looking for a manager and you find across the 7 categories, there are 169 funds that ranked in the top quartile at that time. And putting aside, that doesn't mean they outperformed, but they're top quartile. If you had to guess how many of those remained in the top quartile over the following, 4 years, it's not very big, right? It's 2 out of 169. So that's just over 1% of those funds that seemingly were doing something better than most others, weren't able to stay there. We look at it other ways too, top half over 2 5-year periods, et cetera, and find that just mathematically, there doesn't seem to be a systematic edge. We see a lot of mean reversion, right? Top quartile managers moving to bottom quartile and vice versa. It's actually less common to see a bottom one move to the top, but there is a lot of movement in the middle. And so this proves out that when you see that underperformance rate year to year, or more importantly, those that beat the market year to year, or in the SPIVA data, it's not the same managers. It's changing all the time. And I think that's something that when you put these two pieces together, can really help be rational about how difficult this is for everyone.
Yeah, we always say it's very hard to predict the markets, and this really does prove that out. So I think that's something investors should always be considering, even for the professionals. They're not getting it right all the time. But building on that, and to sort of wrap it up, how can investors use these results in their day-to-day management of their portfolio?
Sure, and I've seen this, and I've asked people this as well, and I think it should make sense. I think there's perhaps three ways that I see SPIVA used. One is active managers themselves sometimes use these data. It's rare, but sometimes they do, to show their clients, their investment committees, their prospects, look how good we are, right? Look how difficult it is to manage what we manage in the spaces that we do. Or maybe to have discussions around benchmarks, et cetera, and where they fit globally. That can happen. The second is, I think for advisors, it's very useful, and I've seen and heard this as well, to have that discussion with their clients around active and passive, and where to really spend their energy and their fee budget, right? I think we've seen with the growth of ETF models, for example, this real shift toward allocating actively with passive instruments, right? And that I feel like is where no one's really giving up on trying to move around in the market, but this really does support the idea of asset allocation and letting diversification do the work for you in indices, which is what the data suggests is happening. And the last is fund selectors. It's kind of related to the advisor side of things. If you're an individual or if you're running a giant global institution, it really doesn't matter. You can see which asset classes around the world are relatively more or less difficult for active success, right? I've had people say, for example, in many cases, we'll use passive in U.S. equity. That's just too hard to generate an outperformance, but we need somebody active in emerging markets or certain areas of fixed income. And the data do show there's a little bit more of a realm for success there, but I think it's about doing things that are different. And now I even hear more discussion around private assets or things that aren't in this public category is where people are. This is just what I observe going, and a lot of that is because of SPIVA, right? The flow that we've seen into passive as a result of this observation.
I wonder if as regulation changes and active mutual fund managers are able to incorporate more of these alternative liquid alts in their portfolio, time will tell, but I wonder if we'll see any shift.
It may be, but I mean, we're we've got an app for that, as they say. We're trying to, we as we expand our own business at, S&P Dow Jones Indices, for a long time, actually, we've been monitoring alternatives, private assets, things like that through benchmarks, through Cambridge Associates, some other, entities that we're associated with. So it's always important to try to see what is the standard, right? What is the price? What should people be looking for so that we can make more and more informed decisions? And I think that's pretty valuable for all of us.
For sure. All right. Thank you so much, Joe, for joining me today. Great insights. As always, I always find SPIVA so interesting, and a bit of a nerd that way too. And I love how consistent it has been over time. The story just remains the same year after year. So thanks for joining me.
Thank you. It's always a pleasure. I look forward to next time.
BMO ETFs, of course, has a wide range of broad index-based ETFs that investors can use to adopt a passive approach to investing. We have the largest S&P 500 ETF in Canada, that's ZSP, the largest EFI ETF, ZEA, amongst others, a lot of which are based on S&P indices. So again, I encourage you to do your due diligence, use our comparison tool on our website to find the best option for you. Thanks for joining us, and we'll see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.